Recently, the UK government announced £43 billion worth of unfunded tax cuts on top of a very generous energy price guarantee. This caused UK deficit to rise from 100 billion to a forecast 200 billion. But unfortunately, markets didn't like it. In a period of high inflation and rising interest rates, markets started selling government bonds, pushing up interest rates, and the government had been forced into a humiliating U-turn, reversing many of the tax cuts. Now, some see this as evidence that the UK needs to return to austerity, cutting spending, raising taxes in order to balance a budget, and it shows that the austerity of 2010 was very necessary to avoid a similar bond crisis. So does the UK need to return to austerity like 2010? When the incoming Conservative government introduced austerity in a bid to reduce budget deficit, their logic was the UK recorded record peacetime budget deficits and they needed to cut spending in order to get the budget under control. Many economists at the time said that this austerity was unnecessary. Why? Well, for many reasons. Firstly, the UK economy was recovering from recession. Growth was very weak. And the private sector were cutting back on spending and investment. There was a rise in private sector saving. So when the government sold debt, there was strong appetite to buy the debt because the private sector had unused savings. And you can see here how the rise in government debt mirrored the rise in private sector saving. And this is a classical Keynesian response to a recession. If private sector saving rises, then the government should borrow to stimulate economic growth and investment. Secondly, in 2010-2011, inflation was very low. It was close to the government's target. There was some temporary cost-push inflation in 2011, but this soon evaporated. And in a period of very low inflation, it's much easier to borrow because there's no inflationary impact of higher deficits. And in fact, Bank of England were buying bonds and creating money through quantitative easing in a bid to stimulate the economy. And this made it even easier for the government to borrow because there was quantitative easing to help buy some of the debt. But having said that, even without the quantitative easing, demand for government bonds was oversubscribed, and it was quite easy for the government to sell the increase in debt. Thirdly, it was a period of falling interest rates. Interest rates were close to zero across the world. The Bank of England had cut interest rates to 0.5% and gilt yields fell throughout this period. So when interest rates are very low, it's much cheaper for the government to borrow. And if you have an investment project such as insulating homes, building new power stations or improving infrastructure, then if they give a return higher than 1 or 2%, the government is creating a net gain. So in this climate of ultra low interest rates, many argued it was a mistake not to take advantage and borrow to invest and improve the long-term performance of the UK economy. So many see the austerity of the 2010s, 2011s as a missed opportunity. It was unnecessary economic pain that wasn't needed because we had low inflation, low interest rates. In a way, the austerity was self-defeating because by cutting spending, it led to lower growth, and this was one of the reasons behind the poor UK economic performance in the early part of the 2010s. Now, the big question is, are things different now in 2022? Do we have to repeat the same austerity, or are there stronger case for austerity now? Well, now there are few things which are actually quite different. Firstly, and most importantly, inflation is close to 10%, which is a completely different scenario to 2010. And this is one reason why the markets reacted adversely. If you have a huge expansionary fiscal policy of tax cuts during a period of inflation, then markets understandably get worried about more inflationary pressures. And because the tax cuts was a big stimulus to the economy, it means that the markets expected interest rates to rise. One of the problems with the mini budget was the sheer scale. It was like far more than was really needed given this situation of inflation. So it was very unwise to have such a big expansionary fiscal policy on top of a very generous price guarantee. But when inflation is 10%, it's a very different situation to 2010 because you can't rely on the Bank of England to print money and buy bonds. In fact, before the mini budget, the bank was doing the opposite. They were actually selling bonds, quantitative tightening. So unfortunately, with inflation of 10%, even modern monetary theory says that there is a limit to government borrowing. And in fact, the classical MMT response to high inflation is to raise taxes. I'm not an adherent of MMT, but I'm just saying that it's important to know that the idea that you can have no constraints to government borrowing is slightly misleading, because that's only true when inflation is very low and interest rates low. But at the moment, we have a different situation. Another issue back in 2010 was that UK debt was very low by historical standards. It was only 40% of GDP, which when you look at compared to the early 1950s with debt over 200% of GDP, it was really quite low. So the panic about debt in 2010 was really misplaced, because it was actually debt was one of the lowest in the UK's history. Now, in 2022, it's not looking quite as favourable, because debt is close to 100% of GDP, which in the past few years hasn't been much of a problem. But with COVID and the energy price guarantee pushing up debt, it's not quite as favourable as back in 2010. I would say there's no immediate reason to be concerned about UK debt, but at this kind of level, you are wanting to start to stabilise debt as a share of GDP and reduce it in the medium long term. I don't think there's any immediate need to do that, and it would be a mistake to panic too much about the debt. But it is getting to a slightly uncomfortable level. Another difference between 2010 and 2022 is that I think it's fair to say the outlook for UK economic growth has deteriorated in the past 12 years. In 2010, after the great financial crisis, I believe that most analysts expected the UK would return to its post-war long-run trend rate of economic growth of around 2.5%. And with this kind of growth, the debt to GDP burden would start to fall when the economy recovered. But since 2010, since the great financial crisis, the UK growth rate has slipped below the long-run trend rate. We've lost a lot of potential output because of low productivity, problems around Brexit, lack of private sector investment, and other issues causing low economic growth. So in 2022, markets are now pricing this in. They don't expect the UK economy to grow like it used to in the past. So this constrains government spending and government finances, because with lower growth, you're going to get a smaller increase in tax revenue, and you'll have to spend more on certain benefits and pensions. Also, the demographic situation in 2022 is perhaps worse than it was in 2010, because we have an ageing population, increase in the dependency ratio, a rise in long-term sick, partly due to COVID, and less immigration, which used to be quite good for boosting tax revenues. So, given the downgrade of UK economic growth forecasts, it does limit the amount of borrowing that the government can pursue in the long term. One reason why debt of 200% of GDP back in the early 1950s was not so much of a problem is because we had a few decades of strong economic growth, which helped debt to GDP to fall quite significantly. So, does the UK need to return to austerity? Well, first of all, it's worth pointing out that the tax giveaway for the mini budget was really reckless in the scale of it, because you had two huge programmes on top of each other. You had the energy price guarantee, which could be up to 100 billion, and also the unfunded tax cuts of 45 billion, which, by the way, were very poorly targeted towards high earners who would probably save quite a lot of it. It would have been better if you wanted to have expansionary fiscal policy to increase universal credit, because there all that would be spent, and it would make a big difference. So there may still be some room for some expansionary fiscal policy, especially if we go into recession. But a complication is that we've got the worst of both worlds. We've got a recession, but also inflation. So with the cost of living squeeze, savings aren't rising like they were in 2010 because people don't have spare cash to save. And this is a problem for government borrowing, in the sense that if savings not rising, there isn't the same demand for buying government bonds, which is a form of using your savings. Also, it's worth pointing out that austerity is always a choice. If we want to spend more on healthcare, education and benefits, definitely we can do. The UK is still a relatively rich country. It has a high GDP per capita. The UK tax rate is actually quite low compared to many of our EU competitors. Here you can see the UK has a tax burden of 33% back in 2019. It's actually increased quite a bit since then to around 37% because of low economic growth and rising taxes. But it's still low compared to other European countries like Denmark, France, Belgium. And despite what the Institute of Economic Affairs may say, there's no reason why high tax countries have to have lower growth. These countries have quite good living standards. They have a well-funded healthcare system, generous social security. And it's not the case that higher tax burden leads to lower living standards. In fact, if anything, it's the opposite. The strongest correlation is that the poorest countries in the world have a very low tax burden, and the countries with the highest life expectancy, highest living standards, Scandinavia, Northern Europe, they all have high tax burdens. And the UK will need to make a choice. Does it want to go for a Scandinavian model, North European model of high tax share of GDP and well-funded healthcare services? Or do we want to kind of perhaps ape the United States with a lower tax burden but more privatisation and private healthcare and weaker benefit system? So it's a choice. Other solutions could involve looking at the triple lock guarantee for pensioners. You can see here how pension spending as a share of GDP has grown quite dramatically. We have more pensioners, and also the government introduced a triple lock guarantee to make sure that pensioners' benefits kept rising faster than, say, the average worker. And if we were willing to perhaps tackle the amount of benefits we give to richer pensioners with their own homes, or tax pensioners more who can afford it, then it'd be a way to save the government money. Another solution would be to have a look at the energy price guarantee. The energy price guarantee is actually quite inefficient because it benefits the richest households the most. Why? Because they have bigger houses, so it needs more heating, and they tend to have more electrical appliances. So this very generous government scheme to cap prices is going primarily to those who need it least. An alternative would be to remove a price cap and give direct income support to help people pay their bills. The benefits of this is that it will be cheaper and more efficient use of government finance and increase the incentive to reduce demand of electricity and gas, because that's something we need to do for environmental reasons, for economic reasons, and avoid the risk of power blackout, which might happen this winter. Is austerity needed? No, I don't think it is. I don't think we have to suffer with cutting necessary government services. But at the same time, we cannot allow unfunded tax cuts because there is a limit on budget deficit given the high inflation and period of rising interest rates. Now, in a future video, I will look at why interest rates may not increase for too long, and within the medium long term they may fall down again, and this may make it easier for the government to borrow a couple of years down the line. But at the moment, they need to tread quite a fine balance between avoiding a very deep recession, targeting money to those who really need it in the cost of living crisis, but also making sure that they don't overextend themselves and cause a crisis in the markets like we saw a few weeks ago. Hope you've enjoyed this video. If you like it, please give it a thumbs up and subscribe to Economics Help. There'll be lots more videos coming out in the future. But if you haven't seen it already, look at the recent video on the costs of Brexit, which is quite interesting. Thank you. Bye.